welcome to the first of two Growing Farm Profits webinars hosted by Southern Sustainable Agriculture Working Group, specifically for agricultural professionals who assist diversified vegetable growers. This webinar is made possible with generous support from the Southern SARE program. Julia, is the webinar being recorded?
Yes, the webinar is being recorded.
Good deal. All right, well, my name is Steve Muntz. I'm the Executive Director of Southern SOG, and I'll be one of your two facilitators today. The other facilitator is Julia Sampson. She'll be joining us as well. We'll be in the background trying to keep everything running smoothly and hoping to help you through it without any trouble. So we look forward to the webinar and glad you're here today. Today's webinar is titled Depreciation and Profitability Management. Depreciation is often looked at only from the view of tax calculation, but should be viewed as the cost to maintain an appropriate stable of equipment. That cost should be included in the production cost to make sure pricing takes it into account. In this webinar, we'll examine depreciation from the standpoint of how it affects farm profitability. Before we begin, I'd like to give you a little background about Southern SOG. The organization began in Newmarket, Tennessee with a group of farmers and farm advocates seeking to raise the voice of Southern agriculture to the national level. Since those early days, Southern SOG has a rich history of partnering with hundreds of organizations and thousands of individuals across 13 Southern states. The mission of Southern SOG is to empower and inspire farmers, individuals, and communities to create an agricultural system that is ecologically sound, economically viable, socially just, and humane. Because sustainable solutions depend on the involvement of the entire community, Southern SOG is committed to including all persons of the South without bias. We work in three primary program areas: sustainable and successful family farms, community food systems, and bringing the Southern voice to the farm policy dialogue. Southern SOG is probably best known for our annual conference. This coming January, we'll hold our 26th conference in Lexington, Kentucky. All of our conferences are renowned for the outstanding practical information provided and networking opportunities. We also have an extensive trade show, 6 pre-conference field trips, 5 short courses, and 2 mini courses. The full conference program should be online at our website by the middle of October. We're very pleased that the Organic Agriculture Research Symposium will be held in conjunction with this year's conference. This symposium is being hosted by the Organic Farming Research Foundation in conjunction with the University of Kentucky and KSU, and will feature researchers from all disciplines related to organic farming and food systems. Participants will come away with the most current information on agriculture, and submissions are being accepted for the symposium right now, so check our website if you'd like more information about that. Now a little bit words about our Growing Farm Profits program. Southern SOG and our partners developed this program in 2011 in an effort to help farmers get to the heart of profitability on their diversified vegetable farms. To date, over 400 farmers, future farmers, and farm service providers have participated in the trainings. Feedback from across the spectrum of participants over time has indeed shown a positive impact on farm profitability. In 2015, Southern SOG offered our first series of single-topic Growing Farm Profit webinars for farm service providers that allowed further exploration of some recurring issues farmers face in profitability management. Recordings of these webinars are available on our website at southernsog.org. This year we're expanding the webinar series by addressing 2 new topics. Today's webinar focusing on depreciation and profitability management, and a webinar on October 20th on preparing farmers to meet with lenders. It's our hope that some of you Texans out there who participate in these webinars will want to dive in a little deeper and join us for one of 2 Growing Farm Profits in-service trainings that we'll be holding in Texas in November with our partners at the National Center for Appropriate Technology and the University of Texas Rio Grande Valley. Our presenter for today's webinar is Jim Munch. Jim is the owner and operator of Deer Run Farm, a certified organic cow-to-finish grass-fed beef operation. He also has a consultancy aimed at helping farmers attain skills to achieve sustainable profit through improved general management and by using data to make strategic and operating decisions. Jim developed the Veggie Compass vegetable crop costing tool, and he's participated in numerous growing farm profits trainings that have been hosted by Southern Sog.
Hello, my name is Julia Sampson and I work for Southern Sog. Before we get started, I'd like to provide you with just a few points on some of the webinar logistics. We have many participants in the webinar today, therefore all phone lines have been muted. The webinar is being recorded. We're going to share a link to the recording soon after the webinar via email, just in case you'd like to watch it again or share it with your colleagues. Okay, each of you should be able to see a control panel like such. It looks like this on your screen. You can expand or contract the control panel as shown by using this orange grab tab right here. You're free to ask and submit questions via the question box right here. It's located on your screen as shown in the slide. We're going to be addressing your questions at the end of the presentation. Now, in order to help us know a little bit more about the audience today and the current level of understanding of our topic, we have a quick pre-webinar survey that consists of just 3 questions. Each question will pop up on your screen, and as I launch the poll, we'll give you about 15 or 20 seconds to respond to each question, and then we'll show the results to the group. So let's give this a try here. I'm going to launch the very first question here. Okay. So, do you currently or will you in the future assist diversified vegetable growers with their farming operations? So if you could just answer yes or no to these questions real quick here. What? Okay. And you should be able to see that poll on your screen right now. I can see that the votes are coming in and most people have voted. We just wanted, a real quick question, yes or no, an answer to that question. So I'm going to close the poll right now and see what we get here. And then share the results with you on your screen. So about 80% of you said yes to that question. We're going to go ahead, thanks for answering part 1 there, we're going to go ahead and launch question 2 there. So question 2. Okay. What's your confidence level in assisting diversified vegetable growers with integrating farm depreciation data into overall cost of production to allow for appropriate product pricing? So that's going to be either none, low, moderate, or high. What's your confidence level? How are you feeling about that? Are you confident about that or not? So let me see. Most of people have voted here, and these are just real quick answers here. We don't want you to think about it real long. We don't want to take much more time. So I'm going to go ahead and close the poll right now and then share the results with you on the screen there. Okay, so we're running about 40 to 50%, and hopefully that 50% will move to a much higher level at the end of this presentation. Okay, I'm going to close that one, and we're going to launch the third and final question here. Okay, what's your confidence level in identifying useful tools to help vegetable farmers understand and properly track farm depreciation? Same sort of answers there. Yeah, your confidence level is none, low, moderate, or very high. There. We got many of the votes are in. 73% of the votes are in here, and I don't see that we have any hanging chats here. So we've got almost all of the answers here. I'm going to go ahead and close the poll and then share the results with you on screen right there. Thanks so much for your participation in this short survey. Now, I'll let Steve go ahead and pass the presentation to Jim Munch for the main portion of the webinar today. Thank you.
I don't have the controls.
Okay, I'm changing it to Jim.
Well, Steve set up the context of what we're going to, and we could really explain depreciation by putting one formula up on the screen and everybody go home. Reality, however, suggests that that it is much more complex than that in the accounting systems on most farms, number one. And number two, reality also says that a lot of farmers really don't look at the cost of depreciation in making pricing decisions and in making decisions about cost. And so there's really two things that we'd like to get across today. One is just the technology of a good computation of depreciation. And the second is some background to use with a farmer to make them interested in even looking at it in the first place. So what kind of farms are we talking about? We're talking about fresh market vegetable farms. Typically they have 40 to 60 crops that they're growing, maybe more, maybe less. They are selling in multiple channels. They're selling direct to consumers through CSA farmers markets, roadside stands. They're selling to restaurants. They're selling to retail stores, wholesalers, consolidators, food hubs. They have a remarkable ability to set prices, and that is one of the reasons that looking at all costs, including depreciation, is so important, because they can actually do something about it. They typically have high labor costs in the content of the cost of the product. They typically have more investment in facilities and equipment than they do in land. And they have lots of equipment, a lot of fixed equipment in the packing shed. They have mobile equipment of a vast variety in the field. None of it's too large. A lot of it is not used at a very high rate, low hours. And because the fresh market vegetable industry is growing, there's a fairly vibrant resale market for most of this equipment. What does this look like in numbers? Well, the numbers I rely on often were out of a survey that was done on 25 farms in the upper Midwest between 2002 and 2004. You can imagine that inflation has drifted anything that has dollars attached to it upwards. So back at the time of this survey, we had large farms shipping on average $10,000 an acre. Today it's not uncommon to see that be $15,000 to $18,000 an acre, with some the upper limit going well over $20,000 an acre. The average labor hours that we see worked on these farms varies from around 2,000 hours per acre on a small farm up to 500 and some on a large farm. Of course, inflation hasn't changed that number. Return to the owner's labor, management, and return to capital per acre shows this sort of fairly high. After all, it's a fair gross sales number per acre. Interestingly, the investment in equipment varies more from one farm type to another farm type than it does with respect to the size of the farm. So in all sizes, the average for just vegetable farms, which might not be into quite as many varieties and selling in quite as many channels, is about 7,400. They're more concentrated on a smaller number of vegetables. In the full-blown 40 to 60 vegetable 5-6 channel farm, we're looking at $12,400 an acre on average, and that is probably a bigger number today. Now, if you look at land values, you come to one conclusion, that investment in equipment is fairly high per acre, driven incidentally by trading capital for labor, and some other auxiliary reasons. For instance, timeliness. As these farms grow, it's more important to be able to do something very rapidly when the vegetables are at their peak, and the best way to do that is with a squirt of capital equipment that can replace labor. But the trend is obvious, that as the farm gets larger, the labor hours go down, and the reason for that is that they are consistently investing about, in the garden market, typical garden market, $12,000–$14,000 an acre per acre that they add. Investment in land is relatively low, and especially versus other agricultural models. Any of you that work with conventional farmers can see that average gross sales per acre in the $15,000 to $20,000 range is unheard of in most of our commodity and animal agriculture models. There's a significant variability in the financial results, parenthetically, similar to conventional farming. And it really points to management skill. And so Southern SOG recognized this amongst the farmers that they service, and has made a campaign that has gone on now for 6 or 7 years to assist vegetable farmers in learning how to manage profit better, to actually manage their farm not for production so much, but for profitability. And they have included a module, if you will, of training for service providers who reach out to these farmers. The guts of this is really within the tool Veggie Compass and within record keeping. You can imagine that if the bulk of the cost is labor, it is very important to keep track of labor, and I might add, very difficult to keep track of labor. And so the efforts of Southern SOG and efforts of other organizations like the University of Wisconsin is to try to make record keeping easier and easier. Veggie Compass, the tool, is actually housed, maintained, Compass.com or through the Southern SOG webpage. They're totally linked together. This tool has been at the university about 7 years, 6 or 7 years. Prior to that, in one form or another, I call it the Model T form, it goes back 13 years. And unlike crop budgets, this is a whole farm profit management tool. In a way, it is what in industry is called a management accounting system versus a for public record accounting system. It takes inputs that are not only financial, but also physical inputs. Farm expenses is financial, farm sales is financial, but also now physical, because farm sales include not only the dollars of sales, but pounds, bushels, pecks. Another input is growing area of each crop, crop-specific expenses, the number of plants that go through a greenhouse on the farm, total greenhouse labor hours by crop, divided between field growing, harvesting, and packing, and then non-crop specific hours. Those are hours really cannot be identified to one crop or another. With that, the system gives the producer the cost of a crop up to harvest, the total cost of a crop through harvesting, the cost to produce each crop in dollars per pound, dollars per unit of measure, if you will, bushels, pecks, however they're heads, price needed to break even, each of the channels that they sell, the total labor hours by crop, gross margin and net profit by crop and by market channel. So what does this have to do with depreciation? Well, the main financial input to this tool is farm expense, and farm expense includes depreciation. In fact, it includes the expense of using equipment altogether. And those are, if you go back to ag economics or ag engineering, those are pretty typically identified as labor, fuel and lubricants, maintenance, and then the cost of owning, which is the one that is rather elusive. And that includes depreciation, insurance on the equipment, storage cost of the equipment, taxes on the equipment, and the cost of money to actually own the equipment. These are cash expenses: labor, fuel, maintenance, insurance, storage, and taxes. Those are very easily and typically caught in an accounting system that is designed for tax-paying purposes, and it's an easy input to Veggie Compass. Depreciation is misleading in most systems that are designed for accounting for tax purposes, and we'll get into some detail about that here in a minute. The cost of money shows up very vividly if the money involved has been borrowed from somebody and there is an interest payment. And that is captured in the accounting system as a cash expense and therefore easily captured by Veggie Compass. So, as I said earlier, rather flippantly, depreciation can be defined by a simple formula and a verbal statement. Depreciation is an accounting method of allocating the cost of an asset over its useful life. Very simple. Math is very simple. Annual depreciation equals the cost of acquiring that thing minus the value at the end of its use divided by the years of use. Quite straightforward. But most farm accounting systems are designed for tax reporting. So the theoretically correct version of depreciation is subverted. It basically, and we'll go into why that is, but it renders it almost useless for doing profit management. Here's the subversion. Tax-driven accounting of depreciation diverges from profit management accounting for a couple of reasons. One is accelerated depreciation allowed under Section 179 of the IRS Code. This is, for these sorts of farms, the upper limit of Section 1, the allowance under 179 is so large that basically if you see an item of depreciation on a Schedule F, I can guarantee you that most of it has been something bought that year and written off that year. Therefore, in that particular year, the year of acquisition, it is very, very high. And so if you used that expense as part of one of these tools like Veggie Compass or even a crop budget, you'd be wildly incorrect. And then there's no expense ongoing. Once you've written it off, it isn't there in your accounting system as an expense anymore. And so in the subsequent years, if you use this to make pricing decisions or to look at cost control, you'd be looking at a zero number. So should not be used for making pricing decisions. And remember, these are farms that the strongest lever of profit management is in who they sell to, what they sell, and the price they ask. Even if you discount Section 179 and say that you would, an accountant would say, well, we can't use Section 179, or I don't want you to use Section 179, and you go to what IRS typically allows for the asset life of most of the things that show up on these farms, that asset life is much shorter than reality. So again, you have high expense during that short period of tax allowable life, and then no expense thereafter. I deal with a lot of farms who have almost no depreciation expense, but yet have this $15,000 per acre investment in stuff on their farm. Therefore, I contend that you should not use this method either as a reason to drive depreciation as an expense. So why is this important? And this really should come home to most of the producers that you interact with. If you look at the $14,000, $15,000 an acre, of investment per acre, and you assume that that stuff is around there 10 or can be depreciated over 10, 20 years, you can very easily see that that could be anywhere from 0 to 10% of the sales that you get off of one of those acres. If you compare that to a reasonable return on sales per acre for market vegetable farm, where you have some compensation allowance built in for the owner and operator, we've seen that to be about, a reasonable return to be about 15% on sales. Well, if that's 15% of sales and depreciation can account for 7, 8, 9% of sales, you can see it has a huge impact on the amount of profitability. And by the way, therefore, the taxes that follow and so forth. So the reason for realistic management accounting of depreciation is to make sure that prices cover full actual cost, and to make sure it's on the radar when people are managing cost and making these decisions. So the basic solution to this is to take all the non-land assets and make a depreciation schedule outside of the financial accounting system that is used for taxes. Very simply, estimate the true years of life based on the hours of use per year versus the expected hours that is possible out of that piece of equipment. And then use a salvage value as the terminal evaluation. So the equation that we looked at before would be acquisition price minus a salvage value divided by the years that you arrive at by taking a realistic view of how long that asset is going to be around and serviceable. Now, a little parenthetical here, because of the pretty hot market for used equipment, the true market value is going to be higher than the salvage value. The true market value is therefore a hidden asset appreciating for eventual access by the farmer. And that's how they should look at it. In other words, when they go to trade that piece of equipment in on a better, more productive piece of equipment, it is going to be worth much more than the salvage value. And even when they leave the farm and sell some of these things, we've seen some of the items actually be sold for a greater price than what they were acquired for. And however, we shouldn't use that fact as a profit management accounting tool. It's just a nice hidden asset that the owner can feel good about. And believe me, I've been on many, many farms where when pushed, most of the operators have someplace squirreled away a list of all their equipment and what they think it's worth today. So this building of an extra, an off the book, so to speak, depreciation schedule is the preferred solution for costing, for pricing. In addition, aside from this hidden list of equipment that all these folks keep, it also forces asset accountability. It makes you look at what you have tied up in assets. So that's what would go into Veggie Compass in the line called depreciation. But we also want to see where this fits into a management activity that I think is very important for these farms, and that is managing the stable of equipment, which is crucial for financial success. Effective management, really, of the capital and labor ratio. Controlling and managing production cost is one element of that. And this has to do with these farms growing and wanting to trade expensive labor trade that out and put a piece of equipment in to do that expensive labor. That is cost management. Also responds to markets. If this speaks to timeliness and it speaks to quality of product. And so it is really a revenue management. It allows access to new markets. It allows access to higher grade markets. And therefore, while you're managing revenue, you're also beginning to manage cost because of the volume increase. Effective management also means making the best use of the capital that you have, capital from profits and the capital from other sources. That then speaks to financial management. There are 4 or 5 handles or decision skills for managing the equipment stable. And we've covered some of them in other webinars. We had a webinar earlier this year where we talked about equipment acquisition, an equipment acquisition process. How do you look at the financials of making a decision about the acquisition of a new piece of equipment? In that same process, we talked about a process to assign capital to the most beneficial assets that can be had for the amount of capital you have available in any one particular year. So the first 2 handles have been covered in an earlier webinar. Profit management to generate the capital is really what we're talking about today. If now we have completed the circle of capturing expense, once we have this elusive depreciation number to put into a tool like Veggie Compass, now we have the ability to better manage profit that generates capital that can be used to support this stable of equipment. One thing we have not talked about this year in webinars but have talked to farmers about is keeping information on the life cycle costs of main pieces of equipment. This is extremely useful when making equipment acquisition processes. Basically what it means, if you're on a paper system or an electronic system, keeping tabs of everything you spend money on a piece of equipment, a tractor, a transplanter, a salad greens cleaner. And what comes out of this is that as those pieces of equipment start pushing up against their useful life, the maintenance costs start going up on those pieces of equipment. They should understand that in order to select which of the pieces of equipment they want to earmark for replacement or upgrade. So what we've tried to do in this set of webinars, and the one that is left, is to flesh out support for each of the pieces of the whole program that we've come forward with in growing farm profits. All of the presentations that we've done either directly or to service providers are on the Southern SOG webpage. Outside documents are available. The link to Veggie Compass is available, and a tutorial on all the record-keeping tricks that we've conjured up is also available. So this should allow you to walk into a producer and be of great benefit to him. Incidentally, one of the prior webinars was an effort to demonstrate how to help a farmer when you don't have a lot of records, or they don't have a lot of records. And it was done through play acting. That also is available on the Southern SOG webpage. So with that, we'll entertain any questions that we might have.
Okay. Thank you, Jim. We definitely have time for questions if folks have any. We'll start with some we have already, and then if you have some that come along in your mind, feel free to ask them. The first one, I guess, is have you ever worked with an accountant who is willing to track the numbers like you want them to, as opposed to just on the basic tax form government system?
A couple. Typically, an outside accountant is not too warm to changing their chart of accounts because they have kind of a cookie-cutter approach to farm accounting systems. But if a farm is large enough to have, or fortunate enough to have a dedicated accountant, either full-time or part-time, they get the logic of this very, very quickly, especially if the farmer gets the logic. If the farmer understands how to use the output from a tool like Veggie Compass, he will push the accountant, or she will push the accountant to make the chart of accounts line up with Veggie Compass. And the way that Veggie Compass main input is the expense item, that very first input we talked about, is designed, lends itself to account assignment through most typical farm accounting systems like QuickBooks for agriculture.
Okay. You talked about keeping information on life cycle costs. You know, there are a lot of beginning farmer programs out there and new farmers who are trying to get into this, and question is there a document out there right now that delineates, you know, some real-time life cycle of some key pieces of equipment for vegetable producers, whether it be just a tractor or the you know, transplanter or something like that? Or is that just something that most everybody just kind of pulls out of the air if they don't have knowledge?
I wouldn't say they pull it out of the air. I mean, this harkens back to anybody that's ever been in the military. There's a record jacket that goes with every piece of equipment, and everything that goes on that piece of equipment or comes off of it, every accident, well, in the case of the military, every gallon of fuel that's put in that piece of equipment is recorded on that jacket. If the question is, are there any data about typical expenses on equipment, I'm sure that if somebody poked around the internet long enough, they could find that. But it's pretty simple. You could do this in a 3-ring binder, or you could do it on a cell phone. Going back to the Army example, a gear job, a lube job, spark plugs if it's a gas engine, are simply recorded as to what you did, when you did it, and how much it cost. That's what I'm getting at for life cycle costing.
Right, right. Okay. I have a question. Do you have any examples or scenarios you could run through to illustrate the principles you could share from actual farm businesses and their equipment stable?
Actually, I was contemplating putting one up in this presentation that was from a fairly large farm here in the upper Midwest, but they decided they might not like me doing that, and I didn't want to ask them. But yes, these off-the-line depreciation schedules actually are done by some large farms that keep good management control of this stable of equipment that they have. I mean, it's a fairly simple thing. If you think about what I said during the time that we were talking about that slide.
Okay.
That really answers your question or not, Steve, but
I think it did. What was that, Jim?
I say it is being done here and there on the better managed farms. I mean, these are farms that are when these surveys are made, are sort of at the top end of the scale on profitability.
Right, right. Okay, okay. Next question is, so most farmers, if they're using accelerated depreciation or IRS allowable depreciation, just totally leave the cost of depreciation out of their pricing revenue planning entirely? So they just missing that cost?
Exactly. And you know, once you point out to them the impact that could have, I mean, it literally gets down to I'm gonna sell beets to Whole Foods. What can I get for?
We're losing you, Jim. Can't hear you.
Literally, when it gets down to what am I going to price my beets to Whole Foods at, these are decisions that are often made under some duress, in that a buyer will call up from a Whole Foods or from a hub, a food hub, and say, I need beets, and here's the price I'm willing to pay. And the farmer has to come up with a price at which he or she feels that they can make some money. And if typically a lot of them are looking, if they are not imbued with all of the profit management training that we've done, they're just looking at getting cash, and they don't know whether they're going to make money on it or not. And even the ones that have kept track of costs, if they've lost sight of the fact that to pay to keep this stable of equipment healthy and productive, can rather grossly underprice a particular thing. And so a lot of farms have overlooked this, even ones that are using Veggie Compass that have not been interacted with about this subject, or have an undervalued cost, and therefore are willing to take an undervalued price for their product.
Right.
And it's one of the reasons that we find farmers that start out with the greatest of aspirations, and after 5 or 6 years in this business find they're not making any money.
Yep, you need to know those costs to be able to determine your price, and it's not an easy thing. And Veggie Compass is certainly a good tool to help it make it happen. got a couple other questions here. Looks like one question just got answered. The other one is, do you know the name of the previous webinar where a farmer has little or no financial documents? Do you remember that? And if you don't,
let's see. I can't remember what. Oh, I know. It was. Let's see. Something about Schedule F, wasn't it?
Schedule F versus tax accounting or something like that for profitability management. I think so. Yeah.
On your
That's a. Jim, we lost you again.
It's on your website.
Yeah, okay. Right, that's right. Julia says oh, she just wrote it to everybody, okay. Just going back to one of the earlier questions, you were talking about kind of high-end farms doing the scenarios. We have one participant who wants to know if there's like a elementary scenario that would be easy to point to. And maybe, I don't know if you have anything like that available or not, but
no, but I can envision whipping this up on an Excel spreadsheet pretty easily. Name of asset,
right.
Acquisition price, years of life estimate, salvage value, and simply do the math that is shown in about the math that's shown with a gray, I think it was a gray or no, tan background, that math, and that is the number that you would use as the depreciation number for that asset throughout its now accurately estimated life, and that would therefore be, and then each asset that was of significant value on the farm would be treated like that, and then for any particular year you would just sum up the piece that accrued to that particular, the piece for that year for that piece of equipment summed across the whole stable of equipment.
Right. Okay. Well, I think that's most of the questions now. We got over a little early. Unless anybody else has more, we'll conclude. I want to thank everyone for joining us on the webinar today. After the webinar, you'll be given the opportunity to take a short 4-question survey that should only take about a minute. We'd appreciate it if you'd complete that survey for us. And we hope you'll be able to join us in Lexington for Southern SOG's 26th annual conference. We're confident you'll come away with plenty of practical tools and solutions to help farmers be more successful, and hear good speakers like Jim Munch as well. Thank you all very much. And don't forget our next webinar on October 20th. That concludes our webinar.